So now let's introduce a topic that we're going to get into in much greater detail in the following couple of videos. I want to think about the federal funds market as a true market, okay? Anytime there's a market, there's supply, there's demand, and we can graph the situation going on in that market. All right, so what we're thinking about here is the federal funds rate and the market, right, that determines that rate. So let's think about who is in this market, okay? First of all, we're going to think about this as a loanable funds market because that's what it is, right? It's banks loaning to other banks, savers, and borrowers, okay? When one bank lends to another bank, the lender, we could call the saver, right? They're putting money away to get more in the future. The other side of the market, they're the borrower. They're getting money to borrow in order to facilitate the investments that they've made, okay? So there's two groups. There are the savers. These are the banks that have excess reserves that they can lend to other banks. Okay? And by the way, these loans are incredibly safe. Banks virtually always pay back other banks. So the fact that these are very safe means that any bank that has excess reserves is going to generally be pretty happy to do so. All right? So you've got the savers, those banks, and then you've got the borrowers. And these are banks that need money, you know, in order to reach their required reserve rate in most cases. And they're willing to borrow from other banks. So the only thing that makes this relationship kind of strange is that both sides of the markets are banks, okay? Which is a little bit unusual for both sides of the market to be the same organizations. The other thing that's kind of strange is when you think about banks, they have a few different options, okay, in terms of saving and borrowing. And those options are not uniform on both sides of the market. Let me give you an example, okay? Let's say that the federal funds rate is 6% and the discount rate is 7%, okay? Given this information, a bank has two choices for borrowing money. They can borrow at 6% or they can borrow at 7%. However, if they're the savers, they can't lend money to the Fed, okay? They can't lend money to the Fed at 7%. So this discount rate only is an option for borrowing, okay? And so we're going to have to be careful with some of the more delicate issues regarding this market. Right now, we're going to try to keep things pretty simple, okay? And then we'll add some complexity in the future, like we normally do. So let's take a look at this market. Because I really want you to understand the supply and demand mechanism that this market exhibits. So let's just draw the market and then let's think about some potential changes we might see in this market, okay? So here it is, quantity of loanable funds. This is the federal funds market, all right? Federal funds market is just a market for bank-to-bank lending. The interest rate is determined in this market. We've got savers. That's banks with extra money that they'd like to lend out. We've got borrowers. That's banks that need money. Maybe they've loaned out too much and they need to borrow some to meet the required reserve rate. And then we have some interest rates that has been reached in this market, okay? And by the way, I've got an equilibrium here. This market almost always operates at equilibrium, okay? So it's normal to expect this. So in this market, what you're seeing right now is the interest rate is 2.5%, okay? So banks can borrow at 2.5%. They can also lend at 2.5%. That's that perfect type of market that we talked about in the past, right? There's lots of money moving around, so the interest rate gets very consistent throughout the market. So the effects that we could see in this market, we could see organic effects, just things that just sort of naturally happen in the economy. Or we could see things like the Federal Reserve getting aggressive with its open market operations, for example. Okay. So first of all, let's start with an organic example. And let's say, we'll do some really complicated ones in the future, but let's start with an easy one. Let's just say that home lending is increasingly profitable. Okay? Banks can make more profits off of home lending than they could in the past. Lending money for homes is now more profitable. And let's assume that this is, a ceteris paribus situation where nothing else is changing in the economy, okay? And let's think about how this would affect the market, okay? The unique thing you need to remember when we deal with this market is usually both of these curves would move at the same time, okay? So let's start with the savers curve. All right, think about this curve right here. Remember, this market is just banks lending money to other banks, right? The savers curve here is the banks that are willing to lend money to other banks. So think about it. Given that home lending is more profitable, do you think banks are more or less willing to lend to other banks? They're less willing, right? Because they'd rather put money into the home mortgages. So the savings curve reduces, it shifts left. Since banks prefer mortgages more now. Okay? So it's going to affect the savings part of this market. Savings decreases since banks prefer mortgages. Okay? And it might actually, for some banks, they may actually flip-flop. They may change sides of the market. They go from a bank that has extra money that they lend into this market to a bank that's run out of money that needs to borrow. Okay? So you'll see that these two are interconnected in a very unusual way for markets. Thinking now to the borrower side, if banks can make really good profits in the home mortgage industry, then they are more likely to need to borrow money. Okay? So borrowing increases because banks need money to facilitate those home mortgages. Right? Banks need money to make home loans. So thinking about our market over here, the effects are the savings curve decreases and the borrowing curve, because banks are more likely to need to borrow, increases, which pushes that federal funds rate up, maybe to 4.5%, okay? This right here, this little organic example that I just did, should make you realize why it is such a tough job for the Fed to do monetary policy, okay? Now, the Fed has a lot of power, which makes things a bit easier, but what you should recognize is they're dealing in an economy that can destroy and create its own money, okay? As that federal funds rate goes up, in a vacuum, ceteris paribus, if the federal funds rate goes up, the money supply goes down, okay? So this in and of itself might change how much money is available in society. Furthermore, loans going out to home mortgages, that also can affect the money supply. So these things that are happening all the time in the economy can actually affect how much money is in society. Because money is not currency, right? Money is anything. It's checking account, savings account, it's what have you, right? So these processes themselves can affect the money supply. And this is why the Fed has to be so diligent about changing the money supply. If it does nothing, the money supply will still change because of things like this happening in the economy. All right? So ultimately what you see here, just to go back through what we just illustrated, when home lending is more profitable, banks are less likely to save their money because they want to loan it out for homes. Banks are more likely to need to borrow money because they're lending aggressively for home mortgages, which means they need money now. So saving shifts left, borrowing shifts right, and we end up with higher interest rates in the federal funds market, right? The federal funds rate would increase. What happens down here? For those of you who took micro, which is all of you, we actually can't tell what will happen to the quantity. It depends on how big these shifts are left and right. All right, so that's an organic example. Let me just give you one more example, and then that will close us out here. Let's now think about things the Fed could do. So now, rather than thinking about something that just happens in the economy, let's think about the Fed actually designing a change. So we'll start out with our federal funds market again. Same market, okay? You should get very comfortable at drawing these markets out. Practice drawing them out or it won't make sense to you. Anytime you see these on an exam, even if it's multiple choice, draw out the market or it's going to be confusing. All right, so let's now think about a Federal Reserve designed change to this market. All right, we've got interest rates of 2.5% in this market. Remember, the savers are banks that have extra money that they're willing to lend out. The borrowers are banks that need to borrow money. There's always money moving around in this market, okay? So let's say that the Fed wants to, let's say, increase the money supply for now. Okay? Now they've got a few ways they can do this, okay? And let's imagine for this example, because we haven't spent as much time on it, let's think about changing the required reserve rate. So let's say the Fed drops the required reserve rate to 5%, okay? Now banks, rather than holding 10% of their deposits, only have to hold 5% of their deposits. The immediate effect is that the money supply goes up because banks now can make more loans. It increases the money multiplier. That's that first step. The second step now has to deal with this market here, okay? So let's think about what the effects are. Let's start with the savers, okay? The savers are banks that have extra money that they're willing to lend out. Now that they only have to hold 5%, there are going to be way more savers in this market, okay? Imagine you're a bank that's holding the minimum, right? You're holding 10% of your deposits. And now the Fed comes out and says you only have to hold 5%. Now I've got a bunch of money I can choose what to do with. That freed up my funds to save it wherever I'd like. And one clear avenue for where I could put that money is in the federal funds market, okay? So we're going to get an increase in the savers market. Because banks have extra money that they can lend out. So that savers curve is going to shift to the right, to S2. Now let's think about the borrowing side of the market, okay? Now the banks only have to hold 5%. There's not going to be many borrowers left. All of the banks now have excess reserves sitting there readily available to use. So the borrowing curve decreases. I hope it's clear why this would be the case, but if banks only have to hold 5%, well, then all of the banks are going to have excess reserves right after this law is put into place, right? Right after this rule is created, all banks are going to have excess reserves. So they virtually have no need to borrow, okay? So this borrowing curve will shift left. Maybe it'll shift a long ways left, but we don't know for sure how big the shift will be. We just know it's to the left, okay? Sorry, I'm going to draw that blue. So we get that leftward shift in the borrower's curve. And the effect on the market is that the federal funds rate will drop to perhaps 1.5%. And again, we don't really know what's going to happen to the quantity. We can talk about that in class if we need to. So, when the Fed increases the money supply, when the Fed drops the required reserve rate to 5%, that alone will increase the money supply. Okay, that's the first step. But when the federal funds rate drops, that also will increase the money supply. Because now banks will be more aggressive, because if they have to borrow, it's not as big of a problem as it was in the past. All right? That's the federal funds market. It operates like supply and demand. It operates as a free market, but the Fed can clearly manipulate it in very predictable ways.